Hello, everyone, and welcome to KJH Insights, our monthly podcast. I'm Sarah Bull, Managing Partner at KJH Investors. Thank you for joining us today on our podcast, where we provide you with an in-depth look at the biggest issues affecting the market and their impact on how we are building and protecting our clients' wealth. I have Joel Clark, CEO of KJ Harrison, here with me today. Joel, as we approach the end of the year, it's a good time to get an update from you. Thanks for joining me today. How are you?
Good. How are you, Sarah?
Great. So, Joel, third quarter ended on a high note with markets really welcoming the Fed's decision to cut rates for the first time, I think, since last December. Can you talk a little bit about the market run here and what's on your mind and the mind of our investment team?
Sure. And this morning we got CPI and was softer, so just more fuel to the fire for those that want rates down, which is obviously bullish for risk assets. We can wind back a bit to April, where we had the tariff scare, and basically since that low, which was a 20 to 25% drawdown that most people have long forgotten, we've had a rally straight off the bottom. And I think most times in markets, they discounted the worst case scenario, and the worst case scenario didn't happen, and sort of cooler heads have prevailed. Not to say that we aren't out of the woods on everything, but the world didn't fall apart. The economy didn't fall apart. The criticism that Trump took in April, he's sort of sitting good. The economy's hanging in, inflation's coming down, which is what he promised. Price of oil is coming down, which is what he promised. And like you mentioned, we have markets at an all-time high, and we're probably about to hit a bit of a Goldilocks next 3, 4, 5 months, where growth accelerates on a year-over-year basis and inflation comes down a bit. That's perfect for risk assets. It's perfect for the broadening of risk assets. So in the very short term, I see a continuation of the trend that we've experienced since the low of April.
Yeah, that's great. I think that's a good summary there. Let's talk about what's weighing on stocks. So, talk to us about the US shutdown and how that might affect the markets.
Yeah, they've shut down the US government, and I think the longest duration of a shutdown was 35 days. We might eclipse that. Markets really not paying much attention to it yet because it's a negotiation, and we know ultimately it's going to end. So unlike the last shutdown where markets fell 3 to 5%, that has not been the case. So, it'll start to weigh on things the longer it goes. That's less money in people's pockets, and that's less money being spent on the economy. But ultimately, it'll be a short-term blip on the map, and we'll be back at it. So it's not something that's overly front and center as a concern for the economy or the market.
And I think the key here, it's not something compared to the threat of the debt limit. It's really more about a lack of agreement versus a risk of default, correct?
Yeah, exactly. And the debt limit, that's all negotiation. They've been lifting the debt limit, seems like every year or every other year for 30, 40 years. So that's been similarly, that's just a negotiation, and it always gets increased because the alternative is too punitive.
And I think the other thing that seems to be weighing on stocks is obviously trade relations. So we have the escalation of China US trade relations. And again, just yesterday, the situation between the US and Canada, especially around the ad with Reagan that the government of Ontario put out. Talk about how that's affecting the market.
I think if you believe that Trump is a transactional president, which I believe he is, it's all part of negotiating. So he is transactional. He does go to the extreme. He moves back off his extreme position in part of negotiating. So I'm of the belief that all of this is just a further negotiation to lock in an agreement, and that's what he's working towards. So the chess pieces move forward, they move back. We think we're in good standing with the US, then we're not. It's all part of a broader negotiation. But, Canada and China, they're putting up a fight. They're not completely rolling over, which is good because they shouldn't. But it's a trade war. It's a tariff war. What you hope happens is it doesn't lead to a full-blown trade war and escalate. So we'll see in the coming months if they've resolve things.
Yeah, and I guess it seems to be that the issues do get resolved before too long. So we will see that. And I guess there's the impending date of November 1st as it relates to the China US relations.
Yeah, exactly.
Joel, in your intro, I just want to go back to something you said about inflation. So, inflation isn't bad for stocks as long as it's accelerating and the Fed is easing. And I think that's important to understand, but eventually could be a problem if, I guess, like in 2022, when the Fed had to tighten policy. But that's not the story today. I think let's dive deeper on that.
Yeah, so the story today is the fact that we're probably too tight from a policy perspective because inflation has actually come down. Evidenced by this morning, inflation was below expectations. So we know we're going to get a rate cut. We might get two, which is good. And I think I mentioned the sort of Goldilocks scenario we're entering where growth is accelerating and inflation is declining in the short term. And that is a very good setup for stocks. Now, we are printing money. We are fiscally spending trillions of dollars. Inflation is not going away. So on a structural medium to long-term basis, inflation is always going to be climbing. Rates will need to follow. We just can't handle deflation or any sort of austerity. We just have too much debt. We have too much leverage in the system. And so I think from a big picture asset allocation perspective, one should really rely on the fact that inflation is growing over the medium to long term and is trending upwards.
In Canada, you've had a slowdown in inflation that's been accompanied by turbulence in the job market.
Yeah, it's a bit that, you can have inflation slowing because the economy's slowing too, which isn't great. And so that's less of a Goldilocks scenario because demand is actually diminishing in Canada. So therefore, less demand for goods. And so there's sort of good inflation and bad inflation. Canada, yes, we have inflation down, but we have growth down too.
And has the run up in gold, because that certainly has been a theme this past, I guess, month or quarter, has the run up in gold really been a hedge against inflation?
Yeah, it's gold tends to work and you can't pinpoint one sort of thing like it's a hedge against inflation, it's a hedge against conflict. They're clearly allowing gold to revalue. Bassett made a comment yesterday that he's very happy with the price of gold. That's very helpful. They carry gold on the books at $42. It's at 4,000. And so it's the one asset that can revalue and can revalue upwards to the benefit of the US government. So they're very happy at where gold is. And so it's the largest reserve currency now. It's huge. It's an important asset. So gold works in funny ways and in different environments. Sometimes it goes against the US dollar. Lately, it's been outperforming with the US dollar on a correlation basis. So it's very hard to sort of pinpoint.
And from an asset mix allocation, how is the investment team thinking about credit in here, given rates, inflation?
Yeah, I think the economy is doing well, but from a valuation perspective, both equities and credit are fully valued. There's not a lot of margin built into multiples. So equities are at historic highs, credit spreads are extremely tight. And so both the credit and equity market, if there's certainly one knock, it's the fact that everything, all the good news is likely priced in. And so even if the economy doesn't fall apart, you could have a bit of a mean reversion at some point from a multiple perspective. So to sort of summarize the position, economy doing well. We have a bit of a reacceleration of growth going into Q1. Inflation is diminishing a bit, which is a Goldilocks scenario. It's good for risk assets. However, multiples are extremely stretched and credit spreads are extremely tight. And so if that perspective changes at some point next year, which I think is what you need to be paying attention to, you could experience some significant turbulence or a correction.
Yeah, I think that's right. We said that even last podcast, right? Volatility is likely to return, especially goes back to what you said based on this V-shaped recovery we've had since April.
Exactly.
Now, when you say volatility is likely to return, that's simply the concept of normal market correction. You're not worried about recession. Peter and the investment team on the latest investment webinar that we hosted said really that's not on the horizon right now.
No, I think Trump's going into the midterms. He wants the economy to be highly cooperative. He wants to point to the economy and the market as indication that he's doing well. So he's going to fight that tooth and nail. They're pumping the system full of liquidity. And so you can't really fight the Fed. We're coming into hopefully an easing cycle. So that's all bullish. But a surprise is a surprise. And those are the things that you can't really predict. And so as we sit here today, everything is sort of status quo and in good shape.
So thanks. I think that's a good summary and a good highlight of the key themes that we're thinking about right now. Is there anything else you wanted to touch on before we wrap up here?
Oh, not really. I think we captured everything.
Well, thanks, Joel. Really value your opinion, and I know our clients certainly do too. So thank you for joining me, and thank you to our listeners for joining us today. We'll be back next month with another issue of our KJH Insight podcast. Wishing everyone a happy November. And if you have any questions, please reach out to your portfolio manager or anyone on the investment team, and we'll continue to provide you with commentaries and updates as the market narrative unfolds.
This podcast is produced solely for informational purposes and is not to be construed as an offer to sell or the solicitation of an offer to buy a security. The information herein is based on sources we believe to be reliable but is not guaranteed by us and does not purport to be a complete statement or summary of the available data. Any opinions expressed herein are statements of our judgment on the recording date and are subject to change without notice. Any unauthorized use or disclosure is prohibited. Receipt and/or review of this presentation constitutes your agreement not to reproduce, display, modify, distribute, transmit, or disclose to others the content, opinions, conclusions, or information contained in this podcast.